now we will discuss section 5, that is chapter 18, 19 and 20. This is the last discussion of the day. We'll discuss the generally accepted accounting principles. If you are based in US, you have to follow US accounting, and US accounting is from FASB, that is the Financial Accounting Standard Board, that makes the accounting standards that are called US generally accepted accounting principles. Opposite, we have IASB, that is International Accounting Standard Board, that is issuing IFRS, International Financial Reporting Standards. Standards are really important because it standardizes the accounting all over the world, so it creates a uniform set of financial statements. That's why it's encouraged to adopt the standards. A lot of standards that is applied on financial asset, financial liabilities, and cash equivalents. So there are 4 basic principles of US GAAP. That is that all accounts are recorded on the historical cost concept, means accounts are not based on, financial statements are not based on market value, because market value keeps changing, so you have to adjust your account. You need a lot of people, a system, and an effort. Maybe it can be the cost of these things will exceed the benefit, so we use an historical cost concept, and of course to adjust to the fair value and the market value, we try to depreciate, amortize based on the situation of the economy. We have to give full disclosures. Full disclosures are really important because this is for the stakeholders, shareholders, investors, government, IRS, FAD. These are all interested in your reports, and they want to see that what you did, where you are, which threshold, what is the management decision and analysis, what are your projection, your forecast. These are really important. And revenue recognition, how you recognize your revenue, what method you use. It's a stage of completion method, it's a risk and reward method, and economic benefit is realized, realizable, measurable, not measurable. These are all determinant for these kind of revenues. And matching principle is really important. We match expenses with the revenue to get our income statements. An auditor typically has certain kind of opinions. One opinion is we call as qualified opinion. That is a bad opinion. If you get a qualified opinion, means it's wrong, it's dangerous, it's not good, it's not effective, you can have troubles. Unqualified opinion, if you are a disclaimer, sometimes we don't give any decision because we don't have enough information, and disclaimers and adverse opinions, these are certain type of opinions. Break-even is a really important concept in a business, on a treasury or in business. Break-even, which the point where there is no where the cost is going to equate your revenue. It's a point where there is no profit and no loss. So we take our fixed cost, we divide it with the unit contribution margin. We take the selling price, actually contribution margin, per unit variable cost. Income statement has sort of a lot of components. Mainly it has gross sale, then it has sale return, it has cost of goods sold, it has opening stock at purchases less closing stock. Then you will get a gross profit, gross margin. Then you have to deduct, you have to add other incomes, you have to less operating expenses and a lot of other expenses. Then you will get the income before interest and tax. Then you are going to deduct the interest and the tax. So this is what is income statement is about. And you can see revenue minus cost of goods sold, gross profit minus operating expenses and amortization. This is really important. Balance sheet has three main components, means asset, liabilities, and equities. Assets are your valuable. You have asset useful life less than 1 year, they are current assets. Then we have non-current assets that are above 1 year. We have current liabilities that we have to settle within 1 year. We have non-current liabilities that we have to settle in more than 1 year. We have equity, that is a residual interest of the shareholders over the assets. So every business has cash flow. Cash flow can be divided into three different streams. One stream is cash flow from operating activity, cash flow from investing activity, from financing activity. Then we have two methods to prepare cash flow. That is, of course, known to the accountants. They use direct method, the grouping income and expenses together. And then we have indirect method to create the segregation, reconciliation of operating income to the net profit. And then they have other two portion, financing and investing. Every business has every instrument need to be calculated from NPV, net present value, IRR, and payback method, and profitability index. These are some methods that we use for prediction and forecasting. And net present value is, if it's zero, means the inflow is equating to the discounted outflows. So this project is good to go. And the IRR is a point, it's a percentage where NPV is zero. Profitability index help us to range different projects that we have. If we are facing capital rationing situation where the situation is really squeezed, we cannot increase the cash, the resources, so we have to be choosy, and profitability index give us a right pitch, right figures that which project we have more profit to go. So we choose 1, 2, 3, and this way profitability index help us in choosing our projects. We have certain ratios like net profit margin. You take income, you divide with the sales. Then we have return on common equity, return on asset, return on capital employed. These are straight calculations. We can see the operational efficiency from gross profit margins. We can see what is the time interest, and we take operating profit, we divide with interest expenses. These are simple ratios. We can see the ratios long-term debt to short-term to capital. So we take long-term divided by long-term plus equity. We calculate an ROI, that is return on investment. We calculate RI, that is residual interest, in which we incorporate the target rate of the investor. So he shows profit after cost of capital is deducted, that income minus invested capital into cost of capital. This is, and then we have economic value added. It's a very simple formula. It shows the after-tax cash flow minus the cost of capital. So we take earning before interest and tax into 1 minus tax rate minus weighted average cost of capital into LT debt plus equity. We can calculate debt to tangible net worth. That is pretty simple. You take total debts, divide by total equity minus intangible assets. Earning before interest and tax, depreciation allowance, margins. We can take EBITDA divided by our revenues. If you want to see how efficiently you're making profit, so operating profit, EBIT divided by revenues. Return on total assets, take your income divided by total average assets. Net income divided by total revenue divided by total assets. And we can use DuPont model also. Take one ratio, divide it into different meanings. It will give you a more quick ratio analysis.